You check your investment account after another volatile week. The numbers are lower than they were a month ago. Headlines warn about uncertainty. Financial commentators debate whether this is the beginning of something worse or simply another temporary decline. Without making any dramatic decision, you begin wondering whether moving everything into cash might be the responsible choice. After all, protecting what you've already earned feels more sensible than watching it disappear. That instinct feels reasonable because safety has always been associated with avoiding loss. In everyday life, we wear seatbelts, lock our doors, buy insurance, and keep emergency savings because reducing risk usually produces better outcomes. It would seem natural for investing to work the same way. When uncertainty increases, stepping away appears safer than remaining exposed. Yet investing quietly operates under a different set of conditions. What feels safest in the present moment can sometimes create risks that only become visible much later. Those risks rarely arrive as dramatic losses. More often, they appear as opportunities that were never captured, purchasing power that slowly declined, or decisions that became increasingly difficult to reverse. Most people don't experience this realization while studying financial theory. They experience it while checking retirement balances during market declines, refreshing portfolio apps after another difficult trading day, or postponing an investment because waiting another month feels more comfortable. These moments feel temporary, almost insignificant, but repeated often enough, they begin shaping long-term outcomes more than any single market movement. The comforting assumption is simple. Risk is something you can see. Falling prices feel risky because the losses are visible on the screen. Cash feels safe because its value appears unchanged. Doing nothing feels responsible because nothing appears to be happening. The difficulty is that markets rarely measure risk only by what is immediately visible. They also measure what remains invisible while decisions are being made. Inflation continues affecting purchasing power, whether investments are growing or not. Markets recover without waiting for certainty to return. New opportunities appear before confidence does. By the time uncertainty has disappeared, much of the adjustment has often already taken place. This creates an unusual contradiction. The moment when many people feel most comfortable investing is often after uncertainty has already declined. Yet that comfort frequently exists because prices have already recovered. The emotional reward of certainty can quietly arrive alongside a financial cost that no longer feels connected to the original decision. Another contradiction emerges during periods of strong market performance. Rising portfolios create confidence. Declining portfolios create caution. Yet the underlying assets have not suddenly become safer simply because recent performance has been positive. Nor have they necessarily become more dangerous simply because prices have fallen. Human perception adjusts much faster than underlying probability. This is where investing begins to reveal something larger than markets themselves. People rarely respond only to numbers. They respond to how those numbers make them feel. A growing account balance encourages patience. A shrinking balance creates urgency. The same person who confidently contributed to retirement accounts every month during steady growth may hesitate after several months of decline, even though their long-term objective has not changed. The visible outcome appears straightforward. Contributions slow. Money accumulates in savings accounts. Investment decisions are postponed until conditions feel clearer. Beneath that visible behavior is a hidden driver. Uncertainty creates discomfort, and discomfort naturally encourages delay. Waiting feels productive because it avoids making a mistake today. But waiting is not the absence of a decision. It is a decision whose consequences simply unfold more gradually. Behavior then reinforces itself. Each additional week spent waiting makes re-entering feel more difficult. News continues highlighting new reasons for caution. Portfolio screens continue displaying volatility. Eventually, certainty becomes the condition required before action feels acceptable. That certainty rarely arrives in the way people expect. Markets often recover gradually, while uncertainty still dominates the headlines. Employment concerns remain. Inflation continues. Interest rates stay unpredictable. Economic forecasts disagree with one another. There is no single morning when risk announces that it has officially disappeared. The longer someone waits for complete reassurance, the more investing quietly transforms from participating in uncertainty to reacting to certainty. And certainty usually carries a higher price than uncertainty ever did. Many people recognize this pattern only after looking back. They remember delaying retirement contributions for several months because markets felt unstable. They postponed increasing investments after reading another alarming forecast. They kept larger cash balances because stability felt more valuable than exposure. None of those decisions appeared irrational at the time. Each one felt responsible within the emotional environment in which it was made. The personal collision occurs because these decisions often emerge from qualities people consider strengths. Responsibility encourages caution. Discipline encourages consistency. Protecting savings reflects careful planning. None of these characteristics are problems. In most areas of financial life, they reduce unnecessary risk. Investing simply asks a different question. It asks whether avoiding visible discomfort today might create invisible exposure tomorrow. That invisible exposure rarely produces immediate regret. Life continues normally. Paychecks arrive. Mortgage payments are made. Grocery shopping costs a little more than before. Retirement accounts remain funded, perhaps at a slower pace. Nothing appears broken. But over longer periods, another pressure begins accumulating. Inflation quietly changes what idle money can purchase. Missed years of compound growth cannot simply be recreated later. Re-entering markets after extended caution often requires overcoming even greater psychological resistance, because higher prices now feel expensive compared to the prices that once felt frightening. What originally felt like protection gradually becomes dependence on future decisions being more successful than earlier ones. This changes behavior in subtle ways. Someone who delayed investing may begin watching markets more frequently, searching for the perfect opportunity to begin again. Every small decline looks like confirmation that waiting was correct. Every rally creates concern about buying too late. The decision itself gradually becomes heavier than the money involved. Meanwhile, life continues adding commitments. Monthly bills remain recurring. Insurance premiums renew. Housing expenses adjust. Family responsibilities evolve. Career decisions become tied to maintaining financial stability rather than expanding future flexibility. The emotional space available for uncertainty becomes increasingly limited. Ironically, pursuing maximum safety can slowly reduce the ability to tolerate the uncertainty that investing has always required. Over time, the greatest risk is no longer market volatility alone. It becomes behavioral rigidity. Once every investment decision depends on feeling completely comfortable, opportunities become increasingly difficult to recognize because genuine uncertainty is almost always present. Markets, economies, and businesses continue adapting regardless of whether confidence feels justified. Perhaps this is why investing is often less about predicting the future than understanding the relationship between perception and probability. The emotions surrounding financial decisions change much faster than the long-term forces shaping wealth. Safety becomes a feeling. Risk becomes an experience. But neither always reflects the underlying reality. Many people spend years trying to eliminate uncertainty from investing without realizing that uncertainty is not necessarily the obstacle. It is often the permanent environment in which investing exists. The search for complete safety can gradually become another form of exposure, not because caution is inherently wrong, but because waiting for certainty changes behavior in ways that only become visible over time. The most significant financial risks are not always the ones that produce immediate losses. Some develop quietly through repeated decisions that feel responsible in isolation, but gradually reshape the future without attracting attention. By the time their consequences become obvious, they often appear less like mistakes and more like the natural result of habits that once felt reassuring. If the moments that feel safest are also the moments most likely to change long-term decisions, then what does safety actually mean in investing? Finance Simplified explores how incentives and pressure quietly shape financial behavior over time.